Alibaba reported their quarterly and annual earnings this morning. So far, their shares have fallen by almost 5%, but is it justified? Let's look at what the company said. So, this quarter, they reported an EPS of $1.58, or about 20 cents less than the estimate, and they missed their earnings because of the $2.8 billion fine. However, their EPS is still 12% up year on year. And this now gives us a PE ratio of 21 for a company that grows by 20% year on year in terms of earnings and 60% in terms of revenue. And this is such a huge discount, it's crazy. So their revenue went up roughly 64% year on year to 187 billion renminbi, or 28.6 billion US dollars, beating estimates by almost 7 billion renminbi, or roughly $1 billion. Their mobile users are up by 23 million. Their China marketplace users are up by 32 million. Unfortunately, their cloud revenue was only 16.8 billion renminbi against the 18.4 billion consensus. So that was a miss. But the company attributes it to one of their biggest clients changing their business strategy. In the future, they will try to address it by diversifying more in terms of their actual customers. Still, cloud revenue is up 37% year on year, which is very good to see. Now, looking at their annual results, we see that their revenue went up by 41% to 717 billion renminbi, or 110 billion US dollars. Their annual active consumers for all of the Alibaba services reached 1 billion. 1 billion. That's a lot. Including 891 million in China and 240 million outside of China. So we can see that their customer base is growing a lot. Their monthly active users on their China marketplace went up to 925 million. Their adjusted EPS for the year, so that's without the fine, was up 23% year on year to $9.94. The net cash provided by operating activities was up 32% year on year to 35.4 billion US dollars. In terms of new customers, around 70% or 60 million of all of its new customers came from less developed areas in China. And this is really important as it's been an area of criticism lately, as analysts were saying that Pinduoduo is outperforming Alibaba in precisely those areas. So we can see that actually Alibaba is putting up a fight. Their cloud computing revenue was up by 50% year on year to 60 billion renminbi, or 9.2 billion US dollars. And finally, their total share repurchases were about $371 million. And what about next year? Well, in terms of guidance, they've given us an estimate of 930 billion renminbi, or a 29.7% increase in revenues. No earnings guidance was given, but we can see that they're expecting a decent amount of growth. Okay, so we've seen the earnings. What now? What's the verdict? I may be too bullish, but I like what I'm reading. I'm seeing all the good signs. Business is booming, revenues are expected to grow, even with the fine, even with the end of the pandemic boost to online sales. I think this is good for Alibaba, and it's a good opportunity for us to get one of China's best tech giants on a discount. A huge, huge discount. So, that's it for me. You can check my detailed analysis on Alibaba here. If you enjoyed this video, let YouTube know by liking, sharing, commenting and subscribing. Thank you for watching, and I'll see you in the next video.